If you've been watching the SEC over the last few months, you've probably noticed something. They are moving. Not in a slow, deliberate, we'll study this for another decade kind of way. They're actually moving. In May alone, the Commission proposed two of the most consequential changes to public company reporting requirements that most practitioners will see in their careers. A fundamental restructuring of the filer status framework that's been essentially frozen since 2005, and an optional path off the quarterly reporting treadmill that companies have been complaining about for decades. And today, we're digging into both, with the filer status proposal as the main event, because for most companies, I think, listening to this podcast, it's the most immediate and concrete operational impact.
Welcome to Accounting Matters. I'm Nicole Harger, here with Adam Olsen. And the timing on this really does matter here because, as Adam mentioned, these rules are proposed. They're not the final ones. So the comment window is open. Practitioner input has a real track record of shaping how these rules ultimately land. And so we'll get into what to watch as this moves towards finalization. But let's start with why the filer status framework needed a rethink in the first place, because the case for doing something here had been building for a long time before this proposal dropped.
Yeah, so the SEC's filer status framework didn't start out complicated. I think it accumulated that way over decades. The large accelerator filers and the accelerated filer categories were codified in the early 2000s, as I mentioned kind of in the opening remarks. And then the smaller reporting company thresholds, those were refined in 2008. The EGC, or Emerging Growth Company designation, that came through the Jobs Act in 2012. And by the end of that process, we now have 5 overlapping categories: large accelerated filer, non-accelerated filer, SRCs, and EGCs, with their own thresholds, their own accommodations, their own different edge cases, their own complexities, right? And that they didn't nest very cleanly if you kind of step back and look at each of those 5. And I think companies in the middle were always spending a lot of time and money and energy just trying to figure out which rules applied to them. And that was before they actually did any of the real work that needed to get done for compliance.
Yeah, and the structural messiness was one problem, but the bigger issue was drift. So your large accelerated filer threshold was set at $700 million back in 2005 when the SEC calibrated it. They were deliberate about the policy balance. So companies above that line represented about 90% of U.S. equity market capitalization, but only 18% of public registrants. The intent was to really concentrate the most demanding requirements on the issuers where the bulk of investor capital actually sat. And that was reasonable, right? The problem is that threshold was never updated, not once in 20 years. And 2 decades of market appreciation has steadily swept more companies across it without any policy decision that was, the right outcome.
Yeah, and today that same $700 million line captures about 35% of registrants, which is nearly double the originally intended population. So what the proposal released on May 19th is actually doing in a significant part is just helping reset that drift that we're talking about. The framework gets collapsed. We go from 5 categories down to 2. So we just have large accelerated filers and then non-accelerated filers. Accelerated filer and the smaller reporting company designation disappears kind of as standalone statuses in this proposal. And then the EGC technically stays on the books, but it exists by statute because in practice it, frankly becomes kind of redundant when you look at some of the accommodations that they've put forth in the proposal. And then again, that large accelerated filer public float threshold, it actually moves from that $700 million mark to up to $2 billion.
What I think is worth underscoring is how the measurement methodology changes alongside the threshold, because that's where the framework actually becomes more stable for companies that are near the line. So under the current framework, you measure float at a single point in time on a 12-month seasoning period, which means companies near the threshold can flip in and out of large accelerated filer status year over year based on market conditions that have nothing to do with the fundamental nature of their business. The new framework uses the average closing price over the last 10 trading days of each of the 2 most recent second fiscal quarters, and a company has to miss or meet the $2 billion threshold in both of 2 consecutive second quarter measurements before any transition occurs. And so once you land in either status, you stay there for at least 2 fiscal years. That gives companies, at the margin at least, a year of advanced visibility before any status change takes effect.
Yeah, and that's a genuine improvement, right, from an operational standpoint. The compliant consequences of crossing from that large accelerated filer threshold today are significant enough, right? You've got more audit fees, you've got to deal with the 404B compliance, probably additional disclosure obligations, just to name a few. And companies that near the line, like I said, have been managing with real uncertainty about whether their planning assumptions are going to hold. The 2-year lock addresses that directly. When you look at the population, like where the population, I guess, would land under the new framework, again, roughly 80% or more of public companies would now be non-accelerated filers. And that remaining, 19, 20% or so, they will be the large accelerated filers, which would still represent about 93, 94% of the total market flow. So the heaviest requirements actually end up more concentrated than they are today, applied to a smaller share of companies that account for a larger share of that investor capital. That's a tighter and more defensible policy balance than, frankly, what we currently have. All right, so let's walk through what it actually means then to be a non-accelerated filer under this proposal, because I think the list of accommodations is pretty substantial and some carry more weight than others. So the one that drives, I think, the most of kind of that cost conservation is that 404B element that I talked about. The external auditor attestation on internal control over financial reporting, in case you're not familiar. So non-accelerated filers would not be required to obtain an auditor's formal opinion on their ICFR, which is obviously the heart of 404B. However, management's 404A evaluation still stays, so that isn't going anywhere. CEO and CFO certifications, again, under sections 302 and 906, those also stay. The control environment, which, documentation, testing, remediation, all the things that go into an effective ICFR, those remain entirely management's responsibility, and those also aren't going away. But again, what does go away is that external auditor need for an independent opinion that management more or less got their internal control framework and reporting structure correct. The SEC does estimate about 1,600 registrants, so roughly 25 to 30% of all public companies, or about 60% of those currently subject to 404B, would effectively become exempt, right? Which I think is maybe welcomed relief for a lot of people that have been having to navigate and deal with that. And so again, for mid-cap companies in that current accelerated filer and large accelerated filer range, this is often the largest single line item in the external audit budget, driven purely, frankly, by that regulatory status. So we're talking about amounts that many have been affected by that can reach sometimes 7 figures annually. So we're talking millions of dollars, right?
Yeah, and the 404B decision is genuinely more complex than the fee calculation alone suggests. The external attestation is a forcing function. Your auditors are required to have documented defensible opinions on your controls, which means your controls have to be designed and operating to a standard that holds up to external scrutiny. When you remove that requirement, you don't automatically lose control quality, but you do lose the mechanism that was continuously pressure testing it. Companies with mature internal audit functions and well-resourced 404A processes can sustain that quality without the attestation. But companies where internal audit has been sized around the assumption that external attestation is setting the floor will need to think carefully about what fills that gap. And that's a governance conversation that has to happen at the audit committee level before any election is made, not after.
Yeah, good points there. And beyond 404B, the audited financial statement requirements also shift. So they move from 3 years to 2 for income statements, cash flows, equity statements, and the 2-year audited balance sheet requirement obviously would stay. Executive compensation disclosures also get scaled considerably. So the 3 named executive officers are required versus the 5. No compensation discussion and analysis is required. No pay versus performance disclosures. And companies become exempt from say on pay and kind of the related advisory votes that typically would be required. A number of other items that become optional are the stock performance graph, you've got the quantitative market risk disclosures and compensation committee reports. And item 404D, which is around related party transaction disclosures, that is also eliminated entirely. So it is a meaningful reduction in compliance when you kind of step back and look at all of these accommodations as it relates to disclosures across the board.
Yeah, and the compensation and governance facing accommodations are probably the ones I'd flag for a separate internal conversation. And that's because they don't live purely in the finance lane. Proxy advisors and institutional investors have built processes and expectations around the say on pay vote and pay versus performance disclosure. Even if the legal obligation disappears, many companies will face pressure from their investor base to maintain those disclosures voluntarily. The compliance question and the investor relations questions need to be answered in parallel, not sequentially. Getting to an answer with the audit committee and then realizing you have a different conversation to have with your top institutional holders is a real dynamic we see play out.
Yeah, and I think that's exactly why the proposal's opt-up flexibility matters so much in practice. So all of these accommodations that we're talking about are explicitly optional. So any non-accelerated filer could voluntarily comply with any or all of those large accelerated filer requirements. So you can drop the 404B attestation, but also keep then the 3 years of audited financials as an example. You could keep say on pay, but maybe opt out of pay versus performance. So the regulatory floor moves, but companies can kind of position themselves wherever above that floor maybe makes sense for their circumstances. So electing more rigorous disclosures in 1 year doesn't lock you in necessarily permanently moving forward. So again, just flexibility across the board as it relates to kind of uplifting those disclosure requirements.
There's also one new obligation coming the other direction that's worth flagging. Non-accelerated filers would be required to disclose material unresolved SEC staff comments that have been outstanding for more than 180 days in their Form 10-K or 20-F. That requirement currently applies only to large accelerated and accelerated filers. It's a targeted new addition, and it's connected to the companion offering reform proposal that would expand Form S-3 eligibility to a broader population of issuers. So it's part of the same overall package. It's not an isolated change. Let's talk about what this means for companies on the path to public markets, because I think the 5-year mandatory on-ramp is one of the more underappreciated elements of this proposal relative to the attention 404B is getting. So under the current framework, a company can qualify as a large accelerated filer as early as 12 months after its IPO if its public float is high enough, which means for high growth companies that go public at scale, the full weight of large accelerated filer requirements can snap on within the first year of being public, which is often faster than the operational infrastructure to support it has been built. So this proposal replaces the 12-month seasoning period with a 60-month mandatory on-ramp. So every newly public company, regardless of float, regardless of market cap, is a non-accelerated filer for at least 5 years from its first day as an Exchange Act reporting company. And that's a structural change to the economics of going public.
Yeah, and it also extends the EGC policy logic to everyone as well, which is also significant, right? So the emerging growth company framework already provided a 5-year on-ramp with similar accommodations, but only below certain revenue thresholds. And again, under this proposal, the on-ramp is universal, so no eligibility ceiling that you got to navigate and think through. Any company that would have qualified as an EGC gets equivalent or better treatment automatically. Any company that would have qualified as an EGC gets those protections too. And the EGC designation, again, stays on the books, but as we kind of talked about in the opening, it becomes largely redundant in practice because of a lot of what we just talked about. There is a specific registration statement change that matters for IPO preparation that we should at least touch on. So currently, non-EGC companies going public need to include 3 years of audited financials in their S1. Under this proposal, non-accelerated filers at registration would only need 2 years, so a little bit of relief there. And that's both, if you think about it, a cost reduction and a meaningful operational simplification, particularly for companies that maybe don't have a long history of GAAP-compliant audited financials readily available to really kick off that IPO process.
For companies that have been on the fence about a public listing, I think this genuinely shifts one part of the calculus, the ongoing compliance cost of being public, and then particularly the management distraction and audit burden in those first few years is consistently cited as a deterrent. So a 5-year window where the heaviest requirements don't apply gives finance teams something they rarely had, which is the ability to build out compliance infrastructure at a measured pace rather than scrambling to keep up with the obligations that hit faster than the organization is ready for.
That's right. But I do want to be clear about some of the things that do not change with this proposal. So let's walk through some of those. So first, Form 8K obligations don't change, and those continue on. Exchange listing requirements, again, don't change. Investor expectations for transparency, those don't change. And then if you just think about it, and we've talked a little bit about infrastructure, and I know we've had conversations on this podcast about readiness for IPOs and things like that, but the demands of running a public company, so your systems, your ongoing controls, the close processes that support SEC investor-grade financial reporting, that also does not go away with the non-accelerated filer election. So the most durable advice for any pre-IPO companies that we can offer, that essentially remains the same regardless of how this rule lands. So you still need to invest in that underlying foundation, because whether you face that 404B scrutiny in year 1 or it comes to you later in year 6, your data quality, your control environment, all those things still need to be there.
SPAC transactions are also worth addressing, specifically to companies pulled into public reporting through a SPAC or de-SPAC would benefit from the same 5-year on-ramp, but the seasoning clock is based on Exchange Act reporting history, which means the timing depends on the specific structure of the transaction and which entity's reporting history controls. So that's not a uniform analysis across deal structures. It's one of those areas where advisors need to be engaged specifically on how the proposal interacts with the particular transaction timeline. The broad principle holds the compliance burdens for newly public companies drops meaningfully, but the specific application in a SPAC context requires transaction level analysis to just make sure you get it right.
Yeah. So let's maybe bring in we mentioned there's 2 proposals the SEC has put forth recently. So let's bring in that companion proposal, because I think it helps complete the picture of what the commission is actually trying to accomplish with this. If you view them together as kind of a package of improvements or efficiencies or accommodations. So about 2 weeks before this filer status proposal that we just walked through here, the SEC voted to propose allowing domestic public companies to voluntarily switch from quarterly reporting to semi-annual periodic reporting. So the mechanism is a new Form 10S, which would replace 3 of the 4 10Qs in a given year. Companies could make the election annually through a new checkbox that they would see on the cover page of their Form 10K. You check the box, you're on a semi-annual schedule for that fiscal year, you leave it blank, you're just going to follow what you do now, which is kind of the quarterly cadence. One thing to keep in mind is that election cannot be changed mid-year, so something you need to think about at the start. And a similar checkbox would be added to Securities Act registration statements, so companies that are going public, they can also make the initial election at that point of their registration.
The structure of what's preserved in that proposal matters as much as what changes. Form 8K obligations are completely unchanged. Material events still get disclosed on an accelerated basis, regardless of your periodic reporting cadence. Earnings releases, significant transactions, officer changes, all are still required on the existing timeline. The real-time event-driven disclosure framework stays fully intact. So what we're really talking about is the periodic financial statement cadence and only on an opt-in basis. The SEC is not proposing to eliminate quarterly reporting. It's proposing to give companies a choice. Whether that choice gets exercised in practice is actually a different question.
Yeah, and that's the more interesting question, honestly. So the SEC's own proposing release flags a telling data point. So when the UK also eliminated mandatory quarterly reporting in 2014, fewer than 10% of companies actually stopped issuing their quarterly financial information. So that, in other words, they kept doing it voluntarily. Mm-hmm. And I think there's a few reasons why, right? So you've got institutional investors. That's what they've known and have come to expect. Same with sell-side analysts. That's something that they're used to seeing. It's what they want to hear. So there's an expectation that you will still continue to provide that information, or maybe your competitors are doing it as well. So the informal market standard didn't shift just because there was a formal legal requirement or opportunity to do less. So said differently, the regulation may move and provide this accommodation, but market practice isn't always going to fall in line with that. And so I think that history is just good context to have in mind as we think about potentially here, if this proposal moves forward, what it might look like for U.S. adoption with this kind of voluntary semi-annual framework.
Right. And which is why I'd frame the semi-annual option as more practically useful for a specific segment than for public companies broadly. So for companies with less active sell-side coverage, more stable and predictable business models, and investor bases with less appetite for quarterly granularity, that option becomes genuinely viable. For companies with active analyst coverage and institutional investors who track quarterly business momentum closely, the formal permission to go semi-annual may not translate into actual adoption. The investor relations reality hasn't changed just because the compliance requirement did. So finance leaders thinking about making this election need to have the investor relations conversations before they make that compliance decision.
Yeah, good points there. I think there's also just some practical complications just at the company level that they need to think about before making this switch. So just a few things to highlight here. So existing credit agreements and indentures often will reference the need for quarterly financial statements, or they may even contain covenants that are tied to quarterly reporting obligations. A covenant that explicitly requires quarterly reporting, in those circumstances would need to be maybe amended or waived by your lender before you could make the selection. And again, that covenant review is a legal and finance exercise that you obviously want to ensure you have buttoned up before any election is contemplated, just as best practice. And then separately, companies with active capital market programs need to think through how underwriter comfort level interacts with the interim financial statements that are more than 135 days old. So even if the SEC rules technically permit it, underwriters may not be comfortable going to market with a semi-annual filer's disclosure package. So it'll be interesting to see how that evolves, if at all, which means that some companies could find themselves still preparing that quarterly financial information to support offering activity even after making their election.
Yeah. And then there's also the exchange listing question, which is one of the bigger open items in the proposal. Mm-hmm. The SEC's framework doesn't address stock exchange listing requirements. And NASDAQ rules, for example, currently require listed companies to distribute quarterly financial information to shareholders. The commission acknowledged that affected exchanges would likely need to consider conforming changes to their listing standards, but that's a separate rulemaking process on a separate timeline. So companies can't assume that a finalized SEC rule automatically aligns with their exchange's requirements. And that's a parallel track to monitor as this rule, moves towards final.
Yeah, so taken together, the filer status proposal and the semi-annual proposal, you're looking at a coherent regulatory direction from this commission, right? So one that reduces what you have to put in filings, the other reduces how often you have to even file them. And both proposals also sit alongside a third piece, so a registered offering reform proposal that the commission is treating as a package. So Chair Atkins has been explicit that the overall policy goal is to reduce friction for public companies and make U.S. capital markets more competitive relative to international alternatives. So whether you agree with every choice or not, I think it's a strategic rationale is coherent here. And the commission is, we've seen it, right? They're moving forth with a lot of urgency around these things.
Yeah. Let's close today with the practical question.
Let's do it.
What should finance and accounting leaders actually be doing right now, given that neither of these rules are final?
Yeah, so the first thing to acknowledge, I think, is that the appropriate response right now is to not start making operational decisions. Again, these are proposals. They're open for comments. It's to understand what those proposals are accurately, assess your current situation clearly, like let's lay out where we're at today and how it aligns against the proposals, and then figure out whether your organization has a perspective worth putting into the record. Again, I mentioned we are kind of in that comment phase, at least at the time of this recording. Mm-hmm. And so the comment process is substantive. The SEC does read those comment letters. So input from finance and accounting practitioners and corporates and other stakeholders here who can speak from operational experience about how these rules work in practice. Those really do help influence, I think, and shape a lot of the final rules before they're made. So if your company would be materially affected by any of the specific provisions, this is your time, right, to engage. Can't complain after the fact if you didn't have a chance to weigh in. So, get your thoughts in.
Yeah, that's a really good point. So for companies that would transition into non-accelerated filer status if this rule is finalized, the current LAFs and accelerated filers below $2 billion, the analytical work starts with a clear accounting of which accommodations actually apply to your situation and what each of them costs to maintain versus what each of them contributes beyond cost. The 404B conversation is probably the most important one, as it needs to involve the audit committee, not just the finance team. The question isn't just what does the attestation cost us? It's what does the attestation do for us and who or what replaces that function if it goes away? And those are obviously very different questions. And the second one deserves the same rigor as the first.
Yeah, and then I'd also add on, so the compensation disclosure changes are the ones that need to go cross-functional, I would say, early on. So bringing your compensation committee, your investor relations team, and if relevant, the proxy advisor into the conversation before a company, exercise any of those accommodations, rather than explaining the decision to them after the fact, I think is a materially different dynamic to think through. Some companies will look at the say on pay exemption and see a straightforward, this is a cost and complexity reduction. So yeah, we're going to take that. I think others might look at it and see a governance signal they're not comfortable sending to their investor base. And so they may continue to move forward providing that information. So I think that judgment really depends on the composition of your shareholder base, right? And the relationships you've built with your major institutional holders and other stakeholders as a whole. And it's not a call, right, that finance probably needs to be making in isolation.
Right. For IPO track companies, the near-term action is really about factoring the proposal into readiness planning, even in its proposed form. If you're planning a 2027 or 2028 listing, your post-IPO compliance roadmap and finance function build-out should be scoped against the new framework rather than the current one. So that probably means you can pace certain investments differently, but it does not mean you defer the foundational investments in systems, controls, and data quality that a public company life requires, regardless of your regulatory category. Whether your first year as a public company brings 404B scrutiny or not, the control environment still has to be there.
Yeah, and then a few specific items to watch as we move through kind of the rule-making process and towards a final rule. So the $2 billion threshold calibration, I think, is the most consequential single number in that proposal. So I imagine commenters are probably going to have strong opinions on that in both directions. So, kind of watching where it ultimately lands is going to really determine how many of those current mid-cap companies end up in which category of filer status. And then the 60-month seasoning period that we've highlighted, I think will also draw a lot of commentary. So particularly from high float IPO candidates that would otherwise qualify as large accelerated filers from day one. On that semi-annual rule we hit on towards the end, so the earnings release liability question I think is also worth monitoring closely. I think the SEC asked for comment on whether Form 8K Item 202 releases should be treated as filed rather than furnished for semi-annual filers. So something to ponder there. And that would be that shift would increase litigation exposure and meaningfully change the risk calculus around how companies communicate their financial results between their annual filings. And then investor and proxy advisor sentiment will shape actual adoption of both frameworks more than any specific rule provision. So market practice, like I said, has had a way of kind of filling whatever space regulation creates, like we saw with the UK ruling. And I think also the institutional investor community will have significant influence over how many companies actually use any of these accommodations that these proposals could make available. All right, so one thing I keep coming back to with this proposal package is what it says about where the SEC thinks the public markets need to go. So the number of U.S. public companies has declined materially over the past 2 decades. That is a fact. Capital that used to flow through, public equity markets has increasingly gone into private alternatives. So whether compliance burden is the primary driver of that trend, I think some people would debate both sides, but policymakers across the political spectrum have pointed to it as a real factor. And I think what the commission is doing here is really a direct policy response to that concern.
Right. And whether or not you think these specific proposals get every calibration exactly right, the underlying question they're trying to answer is legitimate. How do you structure public company reporting so the burden is proportionate to the investor protection interest at stake, without creating so much friction that the public markets stop being the destination for capital formation they're supposed to be? Finance and accounting leaders are in a better position to weigh in on that question more than anyone. And so the comment period is the way to do that.
Yeah, and as we mentioned, previously, make your voice heard. If you've got an opinion on it, now is the time to comment, get those thoughts in there, and then it'll be interesting to kind of watch these rules as they kind of move through the rulemaking phase, like I said, to see where we ultimately land on this. But it's clear the SEC has a point of view and kind of has a mission at hand that they're really trying to encourage more public market activity and provide accommodations. So we'll definitely be keeping an eye on it from the Embark side. And again, if you're a company navigating through that and want to talk about what it could mean for you, we're happy to carry on the conversations with you. So reach out to Nicole or I. We'd love to connect. And thanks to our listeners for joining us here on Accounting Matters. We'll see you on the next one.